Welcome to Financial Revelations. I am your host, David Safransky. And on this episode of Financial Revelations, we're going to talk about what's going on in the economy right now and the influence that government is about to have on our investments. And I'm going to warn you in advance, it's not all rosy. So I want you to be prepared for this. We don't know what's going to happen. We can't predict the future. So we make educated, calculated assumptions about what's going to happen. I don't like saying that they're guesses. We're about to get my cat in the shot here because she wants to be a movie star. This is Opal. She's a rescue. I found out about her after coming home from a trip, which I wasn't really keen on a cat, but now I am. Every morning when I'm reading, she comes out and demands attention and then sits just outside of my reach. You know cats. So we're going to make some calculated assumptions about what we think could happen. And I want to warn you, there is a chance that none of these things will happen. But this is the thought process that I go through when I look at investments and how I'm thinking about what am I going to invest in? How are we going to make money in different situations, different circumstances, different Congresses, different presidents than what we've had over the past 4 years, and the things that they're proposing, how are they going to affect us? And consequently, how do we need to react prior to the market reacting? So we want to be in front of this stuff. We want to be the ones, for instance, last March, right about this time, last March was the market lows. March of 2020, the pandemic was in full force. Every state was shutting down. Nobody knew anything yet. And the market was losing 3,000 points a day. We bought into it. I was thoroughly convinced that the return trip would be as sharp and dramatic as the fall was. And so the minute we felt comfortable buying, we were throwing money at this thing. And so we want to be ahead of what the market is doing, because by the time the market figures it out, it's too late. It's priced in. So here's what's about to happen. We just passed a $2 trillion rescue package, only a small portion of which is going to be spent this year. So it's not really, in my mind, you can't really call it a rescue package because so much of it is not being spent this year in the year when we need it. And we need it right now. So the restaurant workers, the restaurant owners, the service industry, any place where people can gather, get close, they've really been hurting. So those are the people that need it. They need it right now. By and large, they're not getting it right now. But we did just pass $2 trillion, roughly, of rescue package. On top of that, the federal government is now talking, the administration, Biden administration is talking about a $3 trillion infrastructure plan that will all be paid for with debt. Now, the most concerning thing about this is that at some point we are going to have to pay for this. And so they're also talking about tax increases. Now, it started out in the campaign that it was going to be people making over $400,000, but they realized something relatively quickly. There just ain't that many people who make more than $400,000. So we got to lower those tax numbers. Now it's anybody who makes over $200,000. Now, there are a lot of people who do that. The problem for the administration is, there's just not enough of those people. It's going to get drilled down to people, what I would consider just average working people, are going to be paying more in taxes. And the way that they're going to do this is they're going to try and take sections of the tax code and do away with them. For instance, stepped up basis. Most people don't know what this is, but it's a very important tax law because let's say your parents, like my parents bought a house in 1962 for $18,000. It is now worth $175,000. If they die and will that house to the kids, we sell that house at $175,000 and we pay no tax on it because we get it at the value on the date of their death. That's called stepped up basis. And it works with paintings, it works with houses, it works with stocks and bonds and a lot of different assets. And this is a very important tax law. It's because what happens is if my brothers and sisters and I had to pay tax on that house immediately after inheriting it, we're probably going to have to sell it right away at a loss to cover the tax bill. And a lot of people find themselves in those situations. And so stepped up basis is very important. Well, there's no income limit on stepped up basis. So if they take that away, everybody's paying it. The other thing that they're talking about doing with the infrastructure bill to help pay for it is a $1 a gallon federal gas tax. Well, in Ohio right now, a gallon of regular gas is about $2.60. Okay, so you're going to take that gallon of gas and make it 38% more expensive. That's not going to really affect me. I'm going to drive just as much. The person it's going to affect is the person making $25,000 a year with 3 kids and a mortgage payment. They're not going to be able to make this payment. This is very expensive. So it does affect the lower end of the socioeconomic scale at a much higher degree. When you spend $3 trillion that you don't have, you got to get creative in ways to pay for it. They're going to have to get really creative. You know, if you took every billionaire's money, if you just went to their house and said, by the way, we're taking all your money. It's mine. You can't do anything about it. You're now poor. If you took every billionaire's money in America, it would float the government for about 33 days. That's it. And so there's not enough of these people to tax at a high enough rate to pay for all this stuff. So it's going to get passed down to virtually everybody. It always starts out, only 500,000, only 400,000, only 200,000. And the next thing you know, everybody's paying more. And by the way, when they're talking about the corporate tax rate going back up to 28%, if you think corporations are paying that tax, I want to sell you some swampland in Florida, because they don't. They pass it on to you and me. We pay that tax. And the other thing that happens when you raise taxes, think about it this way. When we wanted to get the economy moving faster, what did we do? We sent checks to everybody. We gave people money. Just recently, in the last couple of weeks, people with 5 kids were getting $10,000. A married couple with 5 kids, you get about $10,000 dropped into their checking account. So you're giving people money to get the economy moving. When you tax people, when you raise taxes, when you increase the gas tax, when you do away with stepped up basis, thereby increasing taxes, you're taking money out of the economy. If you supercharge the economy by throwing money at it, what do you think is going to happen when they take money out of it? It's going to slow everything down. What that does is it raises everybody's costs. Everybody's costs go up. Unemployment stays persistently high, consistently high, stubbornly high, and you get into a thing called stagflation, where prices are rising but wages are not. That is a very insidious place to be, and it's hard to get out of. And I'm worried a little bit about some inflationary pressure, so I'm going to start planning for some inflationary pressures coming through the economy. We're already seeing it in fuel prices. We're already seeing pandemic-related price increases in the price of a new build house, 25% higher. You just can't get the wood right now. And if you can get the wood, it is 25% higher. I know people that are trying to build a house, they can't get the wood package for their house. That creates inflation. That creates a scarcity, which drives up prices. And with throwing money at the economy, like we did with people getting stimulus checks, and then a $2 or $3 trillion infrastructure plan, you're putting a lot of money into an economy where there's a lot of shortages right now. That is definitely inflationary. The other thing that they're talking about doing is paying off student loan debt. So let me set this scenario for you. I went to college and I got a degree in art history. And I went to an expensive college, but I didn't really have the money to go to college, so I took out loans for it. Well, I graduated from college with my degree in art history, and I really have 2 options now. I could go teach school, which is not a bad career, or I could go and get my master's in art history, thereby putting reality on hold for even longer while I run up even more student debt. And we're talking now about the federal government paying off that student loan debt. Who do you think is going to pay for that? The same people who are going to pay for the $1 a gallon gas tax, you and me. So let's say you didn't go to college. Let's say that you got a job. Maybe you got a career in welding. So you went to a trade school, you learned how to weld, you went and worked on an oil rig, which the government is now trying to close down because We're so intent on green energy right now when we're an oil-based economy. You didn't go to college, but now you're going to pay for college. Patently unfair, patently un-American, but I have a solution for it. My solution is this. If the government is so keen on taxes and raising everybody's costs, why don't we do this? How about a 90% excise tax on college and universities' endowment funds? You know, Harvard University has the largest endowment fund in the history of mankind. They could pay off everybody's debt that ever went to Harvard right now, and probably 5 other schools of their choosing, and they would still have endowment fund left. But they don't want to do that. Well, colleges and universities caused the problem. They're the ones who convinced me that my degree in art history and then my master's in art history, which still led to no job, would be a viable solution to my educational needs when indeed it wasn't. I want them to spend their sacrosanct college endowment funds to get us out of the problem. They caused it. They have the money. Let them spend their money, not your money or my money. Let them spend their money to get us out of this problem. And then we don't have to float more debt to pay for it. The money is already there. And the things that they do with their endowment funds would make your head spin. It's basically political indoctrination. That's what it is. In a lot of cases, especially a place like Harvard. Make them spend their money. Now, they're not going to want to do that because that's their endowment fund. They're so protective of their endowment fund. They'd rather tax the American people to do it when they're the ones who caused the problem. So the things that I think that are going to cause inflation, at least have the potential to cause inflation, is the runaway spending that we have. Now, I agree that we needed to do something. We needed to do something for people that are really hurting in the economy right now to get us past probably June, July. I think by then, the vast majority of Americans will either have had the virus or be vaccinated against the virus. June, July, probably July. We needed something to get people past that. And we could have done that for a lot less than what we did. So we're talking about $2 trillion on top of 2 other COVID relief bills already passed and implemented, a $3 trillion infrastructure plan, a plan to pay off college debt. All these things lead to inflation because runaway spending, and there's shortages out there now. That's going to drive costs higher. The last thing that could cause inflation is this. It's unique in America. We haven't seen this in a long time. It's a much higher than average savings rate. So right now, the savings rate in January of 2021 was 12.9%. People are saving 12.9% of what they make right now. A lot of people couldn't go out to eat. They weren't spending on credit cards. They were staying at home, not buying gas. They didn't have to buy work clothes. So they're basically saving their money right now. When that demand really unleashes, which I think is going to be June, July timeframe, there is going to be so much money chasing in the system that it could be inflationary. Now, I don't want to be an inflation boogeyman, but I have to see things in the reality of what we're dealing with. It is a possibility that we will not see inflation. It is a possibility that unemployment will come down relatively quickly, and we could be back in that last year, really 2019 of the Trump administration when we were at 3.5%. That is possible. If we do an infrastructure bill and money gets put to work quickly, you're going to see a lot of orange barrels, which means a lot of jobs. So it is possible that unemployment will come down quickly. But I've seen these actors before. I've seen them be totally satisfied with a 1% economic growth rate. We're not going to have that this year. It's going to be really high this year because we're in the COVID recovery. 2022, we're going to get a really good look at what this economy is going to look like going forward out of COVID. And I think that's when we're going to see things kind of slow down to a more normal level. But as we're in the COVID recovery, which is very real, it's happening right now, you're going to see much higher growth rates in the American economy. But that doesn't necessarily translate immediately to more jobs. Hopefully it will. I want to see people working. I want to see all of America working. But we still have to plan for the pitfalls in the economy, and I think one of them is quite possibly inflation. So what do? How do we invest in an inflated economy? When prices are rising, what do we invest in? Well, I have never been a gold bug before. I have never been somebody who pushed gold on people or precious metals, and I'm still not going to be that person. But if you don't have some allocation to precious metals in general, then I want you to reconsider that at least a little bit. Now I'm talking 5 to 7% of your portfolio. So I'm not saying dump all of your money into gold like you'll see on some of these commercials. And remember, every time there's a gold commercial on, they're selling something to you. This is a sales call. And if you buy a newsletter and they're pushing gold, it is a sales call. So you have to look at it like this. Now, when we construct a portfolio, what we want to do is we want to have some fallback positions to where we can go to if we need money. We want to have growth positions because we do think the economy overall will grow over time. So we want to be there. But those fallback positions, 5 to 7 to 9%, one of those could be a variety of precious metals. Maybe an ETF, not just gold, but I like gold, silver, platinum, palladium. Silver especially because it's an industrial metal. Palladium, it's an industrial metal. So as we build more cars, as industry starts to ramp up again, those things will be used. So I like those. The other thing is commodities. Oil has been a really tough trade recently, but it's starting to get better, and I think you're going to see oil prices climb a little bit, which would be good for America. I don't want to see gas at $4 a gallon, and I don't want to see $1 a gallon gas tax because that doesn't contribute anything to the oil industry, which is very prevalent in America now. We are the largest oil producer in the world. We need those jobs. People are supporting their livelihoods, their households, their mortgage payments, their kids, everything in the oil industry, in fracking, in horizontal drilling. We need those jobs. So every time the government talks about cutting back leases on federal lands, you're putting people out of work. And you could drill for oil very cleanly. But, I see a lot of Teslas on the road. I see a lot of EVs on the road today. But for anybody who drives more than 20, 30 miles a day, an EV is not really a good option for you. They're expensive, and they're not really that clean. Where do you think that energy comes from to power that EV? What happens to those battery packs when they go bad? What about the rare earth minerals that we have to mine to make the battery packs? The battery pack in a Tesla, which I love Teslas, and I love Elon Musk. I think he's a national treasure. It weighs 800 pounds. Where are we going to put that thing? So I like commodities. I like some oil, corn, other things like that. Now you could do it, again, in an ETF. I don't want you to go out and buy commodities. REITs, real estate investment trusts, or income-producing properties, another good thing to own because they pay an interest rate. And as prices go up, rents go up, interest rates go up, and you'll get paid more. S&P 500 type stocks, these big stocks that pay a dividend, are a nice inflation hedge. Usually the S&P is going to pay more than inflation, and so I like these big stocks. Next thing I like is leveraged loans. And again, you can do these. They're called collateralized loans. There's a lot of different names for them, but leveraged loans, floating rate loans, another form of a leveraged loan. The floating rate, as rates go up, the floating rate goes up with it. It's kind of like LIBOR plus 5%. And so as the London Interbank Offer Rate goes up, which is LIBOR, your payment's going to go up. So it follows inflation that way. And the last thing, it's kind of a tried and true, is TIPS, Treasury Inflation Protected Securities. Now, you're never going to grow a lot in here, but you will be protected against inflation. None of these things that I have mentioned should be more than 5 to 7% of your portfolio. And when we build a portfolio, I want you to look at it this way. If you have kids, you'll understand this. You ordered pizza on a Friday night. You got 4 kids sitting there and they're starving. You open up that pizza box and oh my gosh, every piece of pizza is cut differently. Some are really big. Some are really small, tiny little slivers. I can tell you right now, the toughest kid in that bunch is going to lay some elbows on people and he's going to get the biggest piece. It's a horrible pizza to show up on a Friday night with hungry kids. It's a great portfolio. The less aggressive things, maybe you have slightly bigger pieces. The more aggressive things, the more growth-oriented things, You have smaller pieces. But what I want you to do, I want you to be wise with your portfolio. I want you to actually construct a portfolio. Do not throw darts at a dartboard to try and pick your portfolio or a stock page. Don't take advice from your Uncle Vinny or the lawn kid. You got to do this right in constructing your portfolio, and that's how you protect yourself. I want you to email questions to Financial Revelations, and it's going to be to Josh at epsf.com. Joshua at epsf.com. The address is right here on my 5-head. Some people have a 4-head. Mine's a little bit bigger. I got a 5-head, and we can put the address right on there. Email questions there. I love getting questions from people. I love getting comments from people. Financial Revelations, you can find us on a lot of different places. I want you to email this to your friends. If you want to get on our mailing list, you can also email Joshua at EPSF. We're going to put out a quarterly letter. It'll go out April 1st, and that'll be on the economy. And I'm going to address some of these things in here, but I like to stay in contact with people. If you have questions, let us know. Financial Revelations, thanks for watching.